Okay, guys, we're going to go ahead and go through the back part of chapter 4. The recording that I made in class the other day, again, didn't turn out, so I'm just going to go ahead and do this from home. If you were in class on Friday, the 16th, when we did the discussion, you've seen this already, but I just want to put it up there for folks that maybe couldn't make it to the discussion. Okay, so when we talk about Social Security, Congress does not want to get into the business of taxing the full amount of Social Security. So they set a limit in that depending on how we go through these threshold formulas, as much as 85%, will be included in gross income. So they'll never tax the full amount. Now we're going to apply two formula, however, to determine how much of the Social Security will be taxable, but it'll never be more than 85%. Now we use this MAGI, and MAGI is basically our adjusted gross income, but we add back some things that would be excludable for adjusted gross income. For example, any tax-exempt interest. Remember, state and local interest from state and local bonds is not taxable at the federal level, but for determining the portion of Social Security that's taxable, then we would go ahead and consider, say, for example, this foreign income exclusion. But just for us to easily remember, tax-exempt interest. I think most of the problems that we'll look at, though, there will be nothing like these, and we'll just go ahead and include whatever they give us as adjusted gross income in the problem. And you'll see those examples in a second. Now we have these base amounts. And you can see there's a first base amount, there's a second base amount, which are predicated on different filing statuses: married, all others, married filing separate. And then you come down and they tell us, and we'll go through those obviously, first set of base amounts first. And they tell us that if the sum of the MAGI, which ends up being the gross income for most questions, is less than or equal to those first set of base amounts, then none of the Social Security benefits will be taxable. Remember, 85% is the maximum. If you don't exceed the first base amounts, then none of the Social Security is taxable. If you do exceed the first base amount, we're going to kick in a formula. If you exceed the second set of base amounts, if you exceed the first set of base amounts, then we'll turn to the second set of base amounts. But first, let's just take a look. Let's say you exceed the first set of base amounts, but not the second. Then the taxable portion of Social Security, will be either the lesser of either the 50% of the Social Security or 50% of our, modified adjusted gross income, plus 50% of the Social Security benefits minus those first set of base amounts, and then again we'll multiply that whole thing by 50%, and then we'll take the lesser of 50% of the Social Security benefits, or that amount, using that wonderful formula. And part of me thinks that they're making it so complicated just so that old people can't figure out how much of their Social Security benefits are being taxed. But anyway, we come over here and we take a look, and we have this married couple. Adjusted gross income is $30,000. We don't have to worry about adding back any tax-exempt interest in this question. As I said, most of the stuff we look at, that'll be the case. Now we come over and they tell us that the Social Security is $11,000, and they ended up figuring out that they have to include $1,750 based on the formula that we saw up here. So let's first pick that 50% of the Social Security is $5,500. Now we have to go through this great formula of which we're going to pick the 50% of the benefits, or the lesser of the formula. Now, just to play this out to how you might be looking at this if you were just having to calculate it from scratch, because they kind of jump to that we've exceeded the first set of base amounts here. You would take this 30,000 plus 0.5, right, of the Social Security, just using this formula right here. 0.5 of the Social Security, which is this 11,000 in this problem. So that gives us what, 5,500. And if you take that, obviously 30,000 plus 5,500 gives us 35,500. Okay. And since they are a married couple, we look at the table. Okay, and we see that what? 32,000 is the first set of base amounts. So 32,000 minus the Maggie plus half of the Social Security benefits. Obviously, they're in excess, and they're in excess here of what? Of 3,500, right? Okay, so they are in excess. So that's what got us into using these formula, because, and they're not in excess of the second set of base amounts here. They kind of gone up to 44,000. So we are in excess of the first set of base amounts, but not the second. So we have to find the lesser of these two amounts, which is half of the Social Security. Okay, coming back to these people, which is 5,500, or the amount in excess of this formula. So they go ahead and, they start saying, okay, well, 50% of the Social Security, 50% of the Maggie plus half of the Social Security minus the first threshold amount of 32,000, which we already know from up here is 3,500. Okay, and so since we're taking out 50% of that amount that is in excess, that means that 1,750 is the amount that is going to have to be taxed here, and so they would have to pay tax on that amount now using this formula, because they exceeded the first set of base amounts. Now they tell us down here, hey, if it had only been 15,000 of their, turned out to be their adjusted gross income, they probably should have called out Maggie again, but there was no tax exempt interest or anything, so it didn't matter. But whether they call it Maggie or adjusted gross income, but technically it should be Maggie, 15,000. Then when you went ahead to see if they had exceeded the first threshold, then the answer would have been what? No, because if you would have taken 50% of the Social Security, the 15,000 plus 50% of the Social Security minus the first threshold, remember the first threshold is 32,000, that is not a positive number, therefore none of the benefits would be taxable. Okay, so they just went ahead and gave us some different numbers there that showed us how they ended up not having to pay tax on any of it. Okay, good. So then we go over and we take a look at this next situation now, which is what if we are in excess of the second set of base amounts. Okay, so if we're in excess of the second, if Maggie plus half the Social Security benefits exceeds the second set of base amounts, the taxable amount of Social Security is either 1 or 2 below 85% of the Social Security, or the sum of, and now we start getting into a similar formula that we saw for the first set of base amounts, but now instead of it being 50%, it's now 85% of the Maggie plus 50% of the Social Security benefits minus the second base amount. And then we have to add on additional amount, which is the amount that would have been included through the application of the first formula, or 4,500 for single taxpayers, or all others, I guess. 6,000 for married, and we picked the lesser of those two amounts to add on. Okay, so before you lose your mind looking at this, let's just go ahead and take a look at this. We have a married couple who files jointly, have adjusted gross income of 62,000. no amounts that need to be added back to give us the difference between gross income and Maggie, so then no tax exempt interest. 12,000 Social Security benefits, okay, and they tell us, hey, we got to pick up this 10,200, which turns out to be 85%, and that must be lesser than the amounts that they figure out here using the number 2 option. So let's just look at that number 2 option, and again we take now 85% of the 72,000 plus 50% of the 12,000 minus the first set, now we're into the second set of base amounts, right? Because they exceeded the first set, so now we look at the second set of base amounts, which is this 44,000, okay? And that gives us this 28.9, okay? And then we have to figure out what is the lesser of these next amounts, and those lesser of those second amounts will be added to this first amount to see if it is lesser than the 85%. I know, guys, I didn't make this up. I'm just showing you how, walking you through these examples, okay? And so we go ahead and we take the amount calculated by the first formula, which is 50% of the Social Security, which is 6,000. And then we go ahead and we take what? We take the 50% of the adjusted gross income, actually the Maggie, minus the first set of base amounts, which is, and remember now, 32,000 for this married couple. Okay, so we go ahead and we take that off. That gives me 23,000 plus what? Plus 6,000. Okay, and so I go ahead and I pick up that the 28.9. Okay, plus what? Plus this 6,000, and that gives me 34,900, which is much greater than what? Than the 10.2, and so only 85% of the Social Security benefits would be taxable, and then we go ahead and then pay the tax on that. Okay, so I don't know, pretty complicated formula. One thing to take away from this that you might be able to see from just looking how these numbers trend is the further you get away from the base amounts, the more likely that the lesser is going to be 85%, whatever the Social Security is. The further away the Maggie gets away from those base amounts would be a more accurate way of saying it, the more likely that you're going to end up having just the 85% or the 85% be taxable. Okay, so what I want to do is go ahead and close out of this. Maybe I'll keep this, I don't know. And I want to go ahead and take a look at the homework problem that I gave you that had the Social Security example in it. Okay, so let's go ahead and take a look at that. Okay, guys, so let's go ahead and let's take a look at this question, which is from the Chapter 4 quiz here. And I just want to go ahead and go through this with you. And so I wrote in the numbers already. And let me see if I can find the laser pointer here. Okay, I guess Word doesn't have a laser pointer, but I'll just go ahead and highlight as we go through this. So we've got Debbie is age 67, unmarried. She has $200,000 in taxable interest. Okay, so there's none of those non-taxable interests like the exempt interest for state or local bonds, etc. So we're going to include that whole $200,000 in just the $200,000. There's no other amounts that we have to consider. And then she has $20,000 of the Social Security. So again, we want to see if she's in excess of the base amount. So we take a look, and we take the $200,000 plus half of the Social Security, 50%. She's got 20% Social Security minus, and the threshold for the first set of base amounts here, just taking a look at our slide, which again for your midterm you can have these with you, is for all others, and she's single, 25,000. So we go ahead and we subtract off the 25,000. She's clearly in excess of the first base amounts, okay? And then we want to see where she is as in relation to the second set of base amounts, and she's in excess of those, okay? We take the, again, 210,000, the 200,000 plus half the Social Security. 34,000 now is the amount for a single taxpayer here using the second set of base amounts. So she is now clearly over both set of base amounts. So we're not going to use that first algorithm that we would have used for the first set of base amounts. We're going to go into this second algorithm, okay, which is going to be either the 85% or the sum of the amounts in excess of the second set of base amounts plus the lesser of half the Social Security amount in excess of the first set of base amounts, and it's 6,000 in this example because they were married, but 4,500 for a single taxpayer, which is the case of Debbie in our example. So just going through this now, we look and we say, okay, she's in excess of the second set of base amounts, so we're going to see the lesser of 85% of the Social Security, which is 17,000, or the amount using the formula for those in excess of the second set of base amounts, which is 85% of the amount in excess of the second base amounts. And I showed you the calculations here, but again, at that point, if we've gone this far, we should go ahead and be able to know to just pick up the amount in excess of the second base of the set of base amounts, which is 85% of that, okay? And then we have to add the lesser of either 50% of the Social Security benefits, which is 10,000, or the amount in excess of the first set of base amounts, which we don't really care now because we can see that is clearly in excess of the second set of base amounts, which, clearly in excess of 50% of Social Security. But again, we could pick it up here. We saw that she was 185,000 over the first set of base amounts. So we picked that number up, or the 4,500. And of these, 4,500 is clearly the lesser amount, okay? And so we picked that up, that 4,500. And of course, the thing's gonna play with me right when we're getting to the point where I could show you how to do this complicated thing, okay? And so we go ahead and we pick up this 149,000. We pick up this 149,600 plus the lesser of these, which the lesser is the 4 or 5. So we pick up that 149,600 plus the 4,005, all to discover that, 154,100 is a heck of a lot more than this 85% of the total Social Security benefits, which was 17,000. So if you pick up the 17,000 now, that would be the maximum over Social Security that could be taxable. We go ahead and we pick up this 200,000 of income that she has, which I'll put right here. I don't think they're telling us this question was easy. Okay, 200,000, which I'll put right here, plus the 17,000, which ended up being at the 85% of her taxable Social Security. That gives us the 217,000, which was the answer to this question here, B. Okay. Now again, as I was trying to say in class, the when we were going through this the other day, the further you get away from the Maggie being further away from those thresholds, the more likely that the 85% of the Social Security is the amount that's going to be taxable. And you can see the way that works, the way these formulas trend. Okay, all right, so not the most straightforward thing in the world. And again, a lot of things go into the calculation of these, and I think one of the things being, maybe they wanted the takeaway to be that they'd only tax 85% of your Social Security, or maybe they wanted the takeaway to be they won't tax any of it unless you're in high income levels. And I guess they figure they can get away with saying that maybe, when they start taxing Social Security. Up and for a while they had lower amounts that they would tax. Okay, all right, so I just want to go ahead and go through these, and I'm not going to go through number one. Just let's start taking a look at number two. Okay, so these are more like what you're going to see on the exam. So we talk about, although I guess I should tell you the answer. Number one is B. She would go ahead and not required to recognize gross income, but she reduced the cost basis of the land. Again, the idea being that it's really, if she's got this $2,000 that she's received from the utility company, the real tax consequence is going to be realized when she goes ahead and recognized when she goes ahead and sells the property. Okay, and she'll reduce her basis. Okay, let's go ahead and let's take a look at number two. The annual increase in cash surrender value of the life insurance policy is not included in gross income each year because of the substantial restrictions on gaining access to the policy value. Okay, they'd have to cancel the policy to get the cash surrender value, so they don't have to pay tax on that until they cash that in or cancel the policy. Number three, with this goodwill, Detroit received $1.5 million since they hadn't previously recognized any value for goodwill, which you do not recognize the cost of internally developed goodwill on your financial statements. All of those costs would be expensed, so there'd be no basis there. And so if they sued and got some value associated with the goodwill through this lawsuit, all of that would be taxable. Okay, taking a look at number four here, we have this Maroon Corporation that is delaying paying the employees into the start of the next year. And they may be considering that there's some tax advantage to the employees, but since the employees are not in control of when they get paid, the employees will not be required to recognize the income until it is received in 2018. I'm going kind of fast through these guys. I'm thinking you probably have already read through these questions at this point. If not, it may not be a bad idea to read these first and then come back to answer specific questions you may have about some of these based on the comments I'm making. Number five, the annual increase in cash surrender value policy is not included in gross income because they must be surrendered to receive the cash. Again, that's that substantial limitation clause that causes us not to have to include certain items in. Okay, and I don't want that right now. Okay, and then let's go ahead and take a look at number six here. And Freddie has a certificate of deposit, and he's going to have to accrue the interest on that and pay tax on it. Okay, so that's one of those sort of difference where we get into the wherewithal to pay. Even though he hasn't cashed a certificate of deposit in yet, he would have to pay tax on the increase in value. And since he purchased that on July 1st, it would only be half of the interest associated with that he would have to take, but he would have to take the income on that. Okay, now that is different than savings bonds. It's nice to be the government because you can make your debt more attractive than non-governmental debt, which is the case here, and that you can defer the interest on the Series E, Series EE, if they're after a certain date. I think it's 79. They're called Series EE bonds. Regardless, you can defer the interest until those mature, so that's a pretty good deal for those. Okay, let's take a look at number 8 now, and we take a look at this Office Palace leased all of its all in one printer to Ashley. The printer was to rent for $600 per month for 36 months. And there's this first and last month's rent. And for all taxpayers, it doesn't matter, accrual, cash, you have to include all rent in the period is received. So since they got the first and the last, 600, you pick those up. We're not picking up, do I still have my highlighter on? We're not picking up the portion that is attributable to the deposit because there's a potential that she would have to go ahead and return that deposit, or they, whoever these people are, in that case. So we don't pick up that $1,500. Okay, just the first and last month's rent. Okay, let's take a look at this one now, and this is something that I was asked a question about, and then I was glad when I saw this problem because it relates to one of the problems I think that there was a question about in the homework, which is we have these contracts, and there's 1 and 2 year contracts. Okay, so some go through 1 year, some go through 1 year. I don't know why they put the 2 years first. Some go through 1 year, and you can see how the service is going to run, and some of it's going to run into 2018 for the 1 years. For the 2 years, we're obviously going to run into 2019. Okay, so for 2017 now, the first year of these, we would just go ahead and take, and for the 1 year contract, it's going to be the $128,000 for those 1 year contracts. And October, November, December is 3 months, so we take $32,000 of that was considered earned in 2017 on those 1 year contracts. On the 2 years, we've got this $144,000, and since it's a 2 year contract, it's 24, 3 months, so we've earned $18,000 of that. So that gives us $50,000. And unique to tax now, we wouldn't do this for financial accounting, but for tax, we're going to sit there and we're going to take the 272, the total on the contract, recognize what we've taken, the 50,000, and the remainder for 2017, the remainder would all be recognized in that next year, this 222,000. Okay, good. Now we come over and take a look at number 10. Daryl, a cash basis taxpayer, has given some stock to his daughter, and he gave up the ownership of the stock, and he gave it to the daughter. And since the daughter now owns the stock, the income associated with that stock, the dividend here, is taxable to the daughter, since he gave up the ownership, if you will, of the tree. Remember the tree and the fruit metaphor. Okay, number 11. Jim and Nora, residents of Community Property State, were married in early 2016 and were divorced. Each earned a salary and received income, and they were married late in 2016. They separated in 2017. They were divorced. Each earned a salary and received income from community-owned investment in all relevant years, and they filed separate returns. Okay, how does it work? Nora only needs to pick up her salary for 2017 since they were divorced, but apparently she didn't divorce the property. Okay, so half of the income from the community property would still be reported on her returns. So even though the marriage may be over, the community ownership in that property is apparently not over, and so she would need to recognize income from half of the community property. Okay. Under alimony rules, income is included in the gross income of the recipient of payments. And we had the question about the new tax law. New tax law, the earner, the person paying the alimony, has to include that in gross income, not the person receiving the alimony, which is an odd change. Maybe they're trying to keep couples together or something, and they want the person that's making the more money to be the one that's motivated to that ends up paying the alimony that's motivated to keep that marriage intact, because they flipped that under the new tax rules in the question I had in class the other day. Okay. Number 12, under alimony rules, we just looked at that one. Okay. So let's take a look at this next one. Number 13, Wayne owned 30% interest in a partnership. Partnership had these revenues, these expenses, and since he owns 30%, okay, he just takes 30% of the income from the partnership, and the drawing that he has really is a distractor, is not relevant, so we pick up that whole $72,000. Okay, taking a look at the next one, number 14, and they have this residence, and they have this stock, and one person gets the residence, the other gets the stock, and so Andrea received the residence, Travis received the stock. So which of these is true? The $50,000 annual payments are made to Andrea or her estate. If she dies before the end, the payments will qualify as alimony if they continue under the current the alimony rules for 20 years before 2018. The alimony, if it continues after the person dies, it's not alimony. Andrea has a taxable gain. No, that is not a taxable gain for her half of interest in the stocks, or for Travis for 1/2 his interest in the house and cash. Those are not taxable events. What happens is you inherit what? You inherit the basis of $500,000 for these stocks, okay? And that $500,000 minus what he sold it for, $900,000, then that's going to create a gain of $400,000 that he would have to pay the tax on, and that is the only correct statement there. Okay, 900 minus 5. Okay, good. Number 15, which of the following is not a requirement for alimony? The payment must extend over at least 3 years. That is not a requirement under the 2017 rules before 2018. Number 16, under the terms of the divorce agreement, Kim was to pay her husband, Tom, $7,000 per month in alimony. Kim's payments will be reduced to $3,000 per month when their 9-year-old son becomes 21. So under the old rules, only $3,000, which is what we're going to be tested on, guys. Using the before 2018 rules, only the $3,000 is going to be taxable, okay, as alimony. Okay, the amounts that stop after the kid reaches a certain age are considered child support. Number 17, the purpose of the tax rules that apply below market loans is to keep someone like the father from loaning money to the daughter, keeping control of the cash, and then shifting that interest income to a daughter in a lower tax bracket. They're going to have to impute interest there. Okay. Number 18, Shannon made a $60,000 interest-free loan to her son, Todd, who has used the money to start a new business. Todd's only source of income were $25,000 from the business and $490 of interest on his checking. And they give us the relevant factors here. And we come up here that we are past the $10,000, but we're okay because we're now going down to that $100,000 category. When we get to the $100,000, we just have to make sure that we don't have any investment income. And when they say investment income, it does not include the $25,000 for a business. Okay, any investment income does not exceed $1,000. Any amounts that exceed $1,000, we'd have to pay the tax on. Okay, and so since he is less than $1,000, he's at $490. Shannon, and it's always the person lending the money that would have to consider whether or not they have to pay the tax, would not have to in that case. Okay. All right, good. Then we've got Jay is a single taxpayer, and he is to receive an annuity of $1,200 each month. Life expectancy is 180 months. He contributed $36,000 to the pension plan, so he has an adjusted basis of $36,000. So he collected 192 payments before he died. What is the correct method for calculating what he should be taking? Now you look, and we take the expected benefit, that's the denominator. We take the payments, that's the numerator. We multiply that by the payments. Okay, he's got 1,200 of payments. So each month, 200 is what is going to be considered the taxable portion. Okay, so he goes through that time, and 200 the 200 is not taxable because that's the return of his capital. And so taxable is not taxable. That's the non-taxable part of his benefits. And then he gets this payments of $36,000 over 180 months. So under the 180 months, he received the return of his capital. That means then that the remaining payments that he gets are now all going to be taxable because he's got his return of capital under the return of capital doctrine. So he continued to receive 12 payments beyond the 180 that returned his capital, and so now he has to pay tax on the full 1440. Okay, and if you look at the number of payments he had, you could see that they did exceed the 36,000. That would have been another way of determining that all the payments that he received after were going to have, after the 180 payments were going to be taxable. Okay. All right, good. And we already went ahead and did that Social Security calculation one. So, all right. So that was the Chapter 4 completion. And so I'm going to go ahead and end this video. I'll put this in under Chapter 4. And I'm going to start a new video that is going to go through the practice midterm. Okay? All right, so that practice midterm video will be up under the module next to the practice midterm. So I'll see you guys in a couple minutes after I get this video set up.